For years, the XRP community has held onto a core belief. The price is tied to one thing and one thing only: global payment utility. The story was simple. As Ripple's on-demand liquidity, ODL, grows, the price of XRP has to follow. But what if that's not the whole story? What if ODL growth, while important, isn't the rocket fuel we've been expecting? For many, that feels like the reality right now. The price has been grinding sideways, creating a frustrating disconnect between the positive news and the chart. This is the exact pain many are feeling. But what if the smartest players in the room aren't even watching the ODL trackers anymore? What if they're focused on a completely different set of catalysts? Over the next few minutes, we're going to break down the powerful forces, from landmark legal rulings to new legislative frameworks, that could make XRP's daily utility a secondary factor and ignite the next major rally. This is the part of the story most people are missing. The frustration is understandable. You saw a major court ruling go in Ripple's favor, you're hearing about new crypto legislation, and yet the price feels stuck. This disconnect is where the real story begins. The old narrative of utility driving price is being overshadowed by a much larger force: institutional legitimization. This isn't about XRP being used for millions of small payments. This is about XRP being cemented into the global financial system as a recognized, tradable, and investable digital asset. Much like Bitcoin, the price drivers are shifting from usage to access. Think about it like gold. Gold's value isn't just from its use in jewelry or electronics. Its value comes from its status as a globally recognized store of value, held by central banks and made accessible through regulated products like ETFs. XRP is on a path toward a similar destination, where its price is driven less by how many payments it settles and more by how much capital can legally and safely invest in it. This requires a new foundation, built not just on Ripple's partnerships, but on the bedrock of law and finance. And that foundation is being laid right now, in two distinct phases: landmark regulatory clarity and the legislative on-ramp. For years, the biggest weight holding XRP down was legal uncertainty from the SEC lawsuit. But that fundamentally changed in July 2023. A U.S. court delivered a landmark ruling that XRP, in and of itself, is not a security. This decision was monumental. It provided a level of clarity that was missing for years and established that the token itself is not an investment contract. This ruling was a huge step, drawing a line in the sand and removing a massive barrier for U.S. institutions that were wary of touching an asset caught in legal limbo. The court distinguished between institutional sales by Ripple, which were deemed securities offerings, and sales to the public on exchanges, which were not. But here's the part most people miss. A court ruling is powerful, but it's not the same as a comprehensive act of Congress. To truly unlock the floodgates for the most conservative institutional money, we're talking pension funds and major asset managers, they need something more permanent. They need a federal law. So the next logical question is, what makes this clarity irreversible? The answer is legislation, like the Financial Innovation and Technology for the 21st Century Act, or FIT21. This bill, which passed the House with strong bipartisan support, aims to create a clear regulatory framework for digital assets, assigning roles to both the SEC and the CFTC. By defining which assets are commodities and which are securities, FIT21 would codify the kind of clarity XRP received in court into federal law, making it permanent. This is the event institutions are truly waiting for. The court ruling opened the door, but the passage of a bill like FIT21 is the engraved invitation to bring trillions of dollars into the room. If legal clarity is the foundation, then institutional-grade products are the on-ramp. These are the pipes that will allow massive, regulated pools of capital to gain exposure to XRP. While the US is still waiting for a spot XRP ETF, the groundwork is being laid. Following the legal clarity in 2023, multiple major firms like Bitwise and 21 Shares filed applications for spot XRP ETFs in the United States. These filings signal that Wall Street's biggest players are ready to offer XRP to their clients the moment they get the green light. Why is this so important? Because ETFs are the bridge. They allow institutions to invest in an asset like XRP through their existing trusted brokerage accounts without worrying about the complexities of self-custody. We can look to Bitcoin's journey for a parallel. When Bitcoin ETFs first launched, the price didn't go vertical overnight. It took months for large institutions to do their due diligence, get committee approvals, and then slowly start buying. Retail buys the news. Institutions wait for the legal frameworks to be set in stone. Once the final regulatory hurdles are cleared and a US spot XRP ETF is approved, it could unlock a significant wave of new capital. The initial buyers will be the early adopters, but the real demand shock will come when the multi-trillion-dollar asset managers follow. Now, to be balanced, we have to talk about the forces working against this thesis. The primary headwind that always comes up is Ripple's monthly escrow unlock. On the first of every month, 1 billion XRP is released from escrow. However, the fear around this is often overstated. Historically, Ripple immediately relocks a large portion of these tokens, typically between 70% and 80%. This means the net addition to the circulating supply is closer to 200 or 300 million XRP, not the full billion. While this does create consistent, predictable sell pressure, it's a known quantity. It's a headwind that can be absorbed by a much stronger tailwind of institutional demand. The real challenge is patience. The institutional world moves slowly and deliberately. Their accumulation often looks like the boring, sideways price action we're seeing right now, not the explosive rallies retail investors are used to. They are building their positions methodically while waiting for the final regulatory dominoes to fall. So, even if XRP's utility as a payment rail were to take a back seat, its value proposition is far from over. A new and arguably more powerful thesis is emerging, built on pillars that are independent of on-demand liquidity. First is the landmark regulatory clarity from the courts, which declared XRP is not inherently a security and is now waiting for a legislative framework like FIT21 to make that permanent. Second is the institutional on-ramp of ETFs, with applications already filed by major players ready to channel capital once approved. The frustration of watching the chart is real, but it might be because many are watching the wrong game. This is no longer just about the future of payments. It's about the birth of a new, regulated, and institutionally backed digital asset. The smart money isn't waiting for ODL volume to prove XRP's worth. They are simply waiting for the law to catch up with its value.